Hello and welcome back to another video on the ComLucro channel. Today, we are going to break down one of the most important foundations of smart money concepts, the concept of liquidity, and how it shapes every movement in the market. Understanding liquidity is essential because price is constantly seeking it, and traders who do not grasp how this process works often end up becoming part of that liquidity. In this video of our Smart Money Concept series, you will learn what liquidity truly represents in technical analysis, why we highlight these zones on the chart, where the major liquidity pools are formed, and how liquidity grab patterns unfold. You will also see how market makers engineer these areas to build their models, helping you read price the same way smart money does and avoid the traps that catch most retail traders. We will also walk through the key liquidity concepts that every trader needs to master before analyzing any chart, giving you the clarity and confidence necessary to interpret market structure with precision. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. So, what is liquidity? Imagine you want to sell several items at a garage sale, but you set it up on a quiet street where barely anyone passes by. You would not sell much there. To actually get buyers, you would need to move your sale to a busy spot where people are constantly walking by. That busy location represents your liquidity zone. In financial markets, the idea is the same. If smart money wants to sell an asset, they need a large pool of buyers. Because of this, price is naturally drawn toward areas where many orders exist, and after sweeping those zones, it often makes its major moves. That is the essential concept behind how liquidity works. In technical analysis, liquidity refers to areas on the chart where many pending orders and stop losses sit. Imagine this as our recent price action. If the market pulls back to a support area, many traders will see it as a buying opportunity because it previously acted as support and resistance. This makes the level a strong structure zone where price can react again. However, smart money views it differently. If they want to buy, they need sellers, which means they need liquidity. Retail traders typically place stop losses below that level, and smart money often targets those stops to gather the orders required to fill their own positions. Now, imagine a scenario where smart money wants to sell a pair. To do that, they need buyers. Liquidity is found where retail traders open trades. In this case, we have a resistance area that rejected price multiple times. If the market returns to that zone, many traders will go short, placing their stops just above it. That means the liquidity sits above the level. To trigger those orders, smart money must push price higher, activating the stops and filling their large sell positions. When price breaks above resistance, breakout traders also enter long, adding even more liquidity. Once smart money collects what they need, price drops again, trapping traders on both sides. Now that we understand the general idea of liquidity, the next question is why we mark these zones on the chart. The first reason is to identify potential targets for price. The market naturally seeks liquidity, so these levels often act as magnets. For example, if there is a major liquidity zone beneath current price, the market may move downward to capture it. By marking these levels, we can better anticipate price targets instead of guessing. The second reason is to avoid getting trapped. Manipulation happens around liquidity areas frequently. When you know where these zones are, you avoid being caught in false breakouts or sweeps that take traders out of their positions. The third reason is planning trades with higher probability. Once you know where liquidity rests, you can refine your entries, exits, and stop losses. For instance, you might wait for a liquidity sweep and then trade in the direction of the next move. This gives you a stronger edge compared to trading without context. Now that you understand what liquidity is, how it works, and why we analyze it on the chart, let me show you the most important liquidity levels you should mark. There are many types of liquidity zones, but let us start with the key ones. The first category is swing highs and swing lows. So, what are they? Swings are turning points where price forms a three-candle pattern. A swing high is a candle with a high surrounded by two candles with lower highs. A swing low is a candle with a low surrounded by two candles with higher lows. These are also known as pivot points, and you can use a 5-candle formation for more accuracy. In this example, these are our clear swing highs and swing lows, and we mark them as liquidity levels because they are structure points where traders have entered before. When price revisits these zones, many traders place orders again, causing liquidity to build up. This is where manipulation often takes place. We only mark unmitigated swings as liquidity, so we remove those that price has already broken. What remains are active liquidity levels, the ones that still matter and are likely to be targeted. It is important to remember that in an uptrend, the liquidity below swing lows is usually more significant than the liquidity above swing highs. The reason is that during pullbacks, smart money often aims for sell-side liquidity beneath those lows before pushing the market upward again. These levels become strong support zones, filled with stops and pending sell orders that provide fuel for the next bullish move. In a downtrend, the opposite holds true. Liquidity above swing highs becomes more relevant as the market often sweeps these zones to collect buy-side liquidity before continuing lower. The next major liquidity zones are equal highs and equal lows. As the name suggests, equal lows form when price creates multiple lows at the same level, and equal highs form when price creates multiple highs at the same level. In terms of price action, equal lows often become excellent areas to look for trading opportunities. Many retail traders expect the price to bounce upward when it returns to this area. Because of that, they enter long positions and place their stop losses just below the level. This creates a pocket of liquidity beneath equal lows, and the same idea applies above equal highs. More eyes watch these zones compared to individual swing points, which means more orders gather there and create larger liquidity pools. Number 3. Turning points. Turning points are areas where the market reversed direction after a long trending move. Traders often view these zones as overbought or oversold. When price revisits them, reactions are usually strong because both retail traders and large participants focus on these levels, causing liquidity to build up. Number 4. Daily highs and lows. Daily highs and lows are important liquidity levels on the chart. The daily high is the highest price reached during the session, and the daily low is the lowest. These points attract significant attention because many traders place their stop-loss orders and pending orders around them, making these zones rich in liquidity. Here's a common scenario. During the Asian session, price tends to move within a tight range, forming clear boundaries. Liquidity accumulates just above and below that range. When the London session opens, price often sweeps above the Asian high or below the Asian low to capture that liquidity. After the sweep, the market usually reverses and makes its main move of the day. To take advantage of this, you can wait for the liquidity grab and then look for reversal setups in the opposite direction, which often aligns with the real directional move of the session. Now that we understand the main liquidity levels, it's time to look at what happens around these zones and how the liquidity grab pattern works. A bullish liquidity grab occurs when price wicks below a liquidity level or even closes below it, but then quickly returns back inside the range. In terms of price action, this shows that the market was reaching for liquidity beneath support by triggering stop losses and trapping breakout traders. This pattern is often a strong sign that price is likely to move in the opposite direction. For example, if price sweeps above the Asian high during the London Open, but then quickly closes back below the level, it shows that buyers were trapped. This creates an opportunity for short setups, expecting price to reverse and move downward. The same principle applies to a bearish liquidity grab. A bearish liquidity grab happens when price pushes above a key liquidity level, activates stop losses and buy orders, and then quickly reverses back below the level. This signals trapped buyers and rising selling pressure, often leading to a downward move. In a clear downtrend, once the market collects enough liquidity, the next bearish leg is likely to unfold, creating a short trading opportunity. When a liquidity grab forms at a resistance level, it becomes a strong indication that price may start moving lower. The liquidity grab pattern is an early reversal signal, but to increase its reliability, you can combine it with a change of character. Here is how a valid liquidity grab and true reversal appear on the chart. Imagine the lowest point of this level is where the liquidity sits. In a valid liquidity sweep, we want to see price wick through that level and then close back above the range. Or we can see one candle close below the line, followed by the next candle closing back inside the range. This indicates a possible temporary reversal toward the supply level ahead of price. As price then breaks and closes above that supply zone, we have a change of character, confirming that the downtrend is over and a true reversal is forming. Combining the liquidity sweep with the change of character gives clearer insight into future movements. Now that we understand liquidity levels and liquidity grab patterns, let us take it one step further and discuss buy-side and sell-side liquidity and how market makers engineer these areas. The liquidity above a high or cluster of highs is called buy-side liquidity, while the liquidity below a low or group of lows is called sell-side liquidity. Here's the key idea. The market is always moving from one liquidity pool to the other. After sweeping sell-side liquidity, price often aims for buy-side liquidity next. Once stops below the lows are triggered and liquidity is collected, the market frequently shifts direction and runs toward the highs to capture the liquidity resting above them. Sometimes, price consolidates in a range and builds liquidity on both sides. After collecting liquidity from one end, the market often travels to the opposite side to continue the cycle. This behavior is central to the market maker model. The model explains how smart money creates phases to engineer liquidity. First, they accumulate orders within a range. Then, they push the market in one direction to gather liquidity. Finally, they reverse the price toward the true intended move. The important point is that buy-side and sell-side liquidity pools act like magnets. You want to identify where these pools are because price tends to move toward them. If price is trending upward, it will usually reach for the next buy-side liquidity above. If it is trending downward, it will typically move toward the next sell-side liquidity below. These liquidity pools act as natural magnets for price, giving us clear reference points for entries, targets, and exits. Once you understand how price rotates between these zones, you stop guessing and start trading with intention, aligning your decisions with the flow that guides institutional movement. Before we wrap up, take a moment to reflect on why understanding liquidity truly matters. Concepts like buy-side and sell-side liquidity, liquidity grabs, and engineered liquidity are important because they shape how you read the chart, anticipate movement, and make decisions when the market speeds up. The clearer your understanding of how price rotates between liquidity pools, the easier it becomes to stay patient, trust your levels, and execute with confidence. But technical knowledge alone is not enough. To use these concepts consistently, you also need to understand how liquidity behaves inside market structure. That is why, before we finish, we're going to show you a short clip from our Smart Money Concepts course. In this segment, you will see how internal and external liquidity zones guide institutional price delivery. Let us take a look. Liquidity can be classified into two types: static liquidity and dynamic liquidity. Let's briefly explain both. Dynamic liquidity refers to the factors that influence market direction and movement. In simpler terms, it represents the elements that drive market movements. To better understand this, imagine a market structure like a rally wave, consisting of a high and a low. These highs and lows represent external liquidity. External liquidity pertains to the highs and lows within a rally wave. Conversely, the fair value gaps found within the range of the high and low are considered internal liquidity. Price in the market always moves between internal and external liquidity. Think of it as a continuous cycle where price moves either from internal to external liquidity or from external to internal liquidity. Looking at this schematic figure, it shows a rally wave moving upward, sweeping the external liquidity gathered above the previous high. After this, the price shifts toward internal liquidity, indicated by this fair value gap, to fill the gaps left behind from internal liquidity. The price then transitions back to the external phase. Essentially, the price moves from the fair value gap to external liquidity by sweeping the liquidity above this high. With the external liquidity swept, the price then aims to balance by targeting internal liquidity. This causes the price to drop and fill the most recent fair value gaps. That clip is a clear reminder that consistency is not about predicting every move. It comes from staying grounded, controlling your reactions, and following your plan even when the market becomes unpredictable. Traders who manage their behavior with discipline are the ones who turn these liquidity concepts into steady, long-term performance. So, trader, if this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.